This is TradeFlow News, bringing you relevant news and insights from around the world. TradeFlow News, enabling trade for SMEs and economies worldwide.
These are some of the key topics that we will be looking into in today's program.
First, let's take a look at the overnight headlines which are impacting the commodity markets. Oil prices fell by more than $1 per barrel on Tuesday as bearish economic data from key global economies heightened demand fears. International benchmark Brent crude futures fell by $1.30 to $91.96 per barrel by 11:17 GMT, after easing 0.3% in the previous session. U.S. West Texas Intermediate crude futures for December delivery fell by $1.24 to $83.34 per barrel, after a previous decline of 0.6%. Supply and demand fundamentals remain largely stable, leaving economic sentiment center stage for the oil market, said Vandana Hari, founder of oil market analysis provider Vanda Insights.
U.S. exports of nitrogen fertilizers jumped to a multi-year high this summer after surging natural gas prices in Europe drove up costs of producing the crop nutrient there, making U.S. shipments more competitive. The brisk U.S. sales highlight the far-reaching effect of the war in Ukraine on global food and energy supplies. Russia, under financial sanctions, is a major producer of fertilizer and natural gas, key in making nitrogen products to boost yields of corn and other crops. Since Russia's February invasion of Ukraine, Europe started weaning itself off Russian natural gas, and a pipeline transporting ammonia from Russia to a Ukraine port shut down.
Moving on to the top news in the energy sector.
Tightening markets for liquefied natural gas, LNG, worldwide, and major oil producers cutting supply have put the world in the middle of the first truly global energy crisis, the head of the International Energy Agency, IEA, said on Tuesday. Rising imports of LNG to Europe amid the Ukraine crisis and a potential rebound in Chinese appetite for the fuel will tighten the market, as only 20 billion cubic meters of new LNG capacity will come to market next year, IEA Executive Director Fatih Birol said during the Singapore International Energy Week. At the same time, the recent decision by the OPEC and its allies, known as OPEC+, to cut 2 million barrels per day, BPD, of output is a risky decision as the IEA sees global oil demand growth of close to 2 million barrels of oil per day this year, Birol said.
Russian coal exports to energy-hungry China have jumped by about a third this year, but the supply boom is being constrained by transport infrastructure limitations, industry sources and officials said. China is seeking coal supplies from overseas, in particular after recent COVID-19 outbreaks in the major coal mining regions of Inner Mongolia and Shaanxi forced many mines to close, while coal demand at power generation and heating sectors will soon pick up with the coming of winter. The Kremlin plans to increase its energy supplies to Asia, China in particular, to offset a slump in exports to the West, which has imposed sanctions on Russia over the conflict in Ukraine.
Next, we have the top news in metal markets.
Buyers of refined copper in China, the world's biggest consumer of the red metal, may raise their purchases of Russian supply next year to reduce the impact of an expected increase in premiums from other global miners. Premiums of physical copper sales to China in 2023 are expected to rise to between $150 to $210 per ton over the benchmark London Metal Exchange price, according to forecasts from 4 market participants. That would be up from $105 this year and $88 in 2021. Chile's Codelco, the world's top copper miner, raised their premiums for sales to Europe next year to a record $234 a ton for 2023, up 83% from 2022.
Iron ore futures slumped on Tuesday, with the Dalian benchmark contract hitting a 7-week low, while prices in Singapore sank below $89 a ton as China's steel demand season draws to an end with a disappointing outcome. The most traded January iron ore on China's Dalian Commodity Exchange ended daytime trade 1.9% lower at 669 yuan and 50 fen, $91.64 a ton, after touching its weakest since September 2 at 662 yuan and 50 fen. On the Singapore Exchange, the steelmaking ingredients benchmark November contract was down 2.4% at $88.50 a ton by 07:05 GMT, after hitting an 11-month low of $88.20 earlier in the session. We will now look at the top news in the agricultural sector. Malaysian palm oil futures rose on Tuesday to their highest in 8 weeks, but profit-taking on weaker rival soy oil and crude oil prices as well as lower October export data limited gains. The benchmark palm oil contract for January delivery on the Bursa Malaysia Derivatives Exchange gained 28 ringgit, or 0.68%, to 4,129 ringgit, $872.39, a ton. After trade resumed following a long weekend, palm oil futures were lifted by a weak ringgit and other commodities market rebound, a trader based in Kuala Lumpur said.
That is all for today's news on commodity markets. Stay tuned to TradeFlow News as we continue to provide you with more updates. We also invite you to follow us on Twitter at TradeFlow News, which allows you to watch our program on your mobile device or desktop to receive information from there.